Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us again here. Let's get across how we ended up last week on Friday with global equity markets finishing in mixed territory. That was ahead of those US-China tariff talks that took place in Switzerland over the weekend, which President Trump called a total reset between the two largest economies. Now, US stocks did end largely lower, the Nasdaq just finishing flat there on Friday. To be overall, the major indices down slightly for the week. Among the Mag 7, Nvidia, which is due to report earnings at the end of this month, ended off marginally as well. Microchip technology shares, they surged after an upbeat current quarter guidance. Lyft increased its stock buyback program to $750 million and beat first quarter profit estimates, signalling steady demand for its ride-hailing services, sending its shares skyrocketing. Expedia shares slumped after the online travel platform missed quarterly revenue estimates. And Pinterest forecasts current quarter revenue above estimates, signalling its AI tools are boosting advertising spending on the platform, sending its shares up 16% in extended trade. Well, in the wake of the trade talks between the US and China in Switzerland over the weekend, President Trump said setting 80% tariffs on Chinese goods seems right, suggesting he's willing to lower the current 145% levy he's imposed. China officials, meanwhile, saying that a sustainable development had been achieved. Meanwhile, India has offered to slash its tariff gap with the US to less than 4% from around 13%. In exchange for an exemption from US tariff hikes. And in the latest Fed commentary, FOMC member Adriana Kugler saying policymakers should hold interest rates steady for now, saying overall we see health still in the real economy, so that gives us time to make sure that we continue to make progress on inflation and we keep our inflation expectations very well anchored. While Thomas Barkin has said, what I'm hearing from retailers is that consumers are about tapped out. And that means it's nice to say you're going to pass it on, but it's not as easy to pass it on as you might think. Well, the latest inflation reading in China shows consumer prices actually fell slightly in April. Now, the US 2-year Treasury yield rose to 3.89%, the 10-year up to 4.38%. Markets pricing it as 15% chance the Fed will cut at its next meeting in June. And the US dollar index down slightly on Friday, the Aussie trading at 64.2 US cents. And Bitcoin has continued its ascent to be trading above 104,000 US dollars. On the commodities front, oil prices rose on Friday to register their first weekly gain in a month as a US trade deal with the UK turned investors optimistic ahead of those talks between the US and China. Brent crude futures rising more than 1.5% to $63 a barrel. Copper was up more than 1%, iron ore up slightly to $98 a tonne, and gold rising more than 1% on Friday, but it has since come back about 1% or so. Spot gold was at $3,340 an ounce. Last week, it put on more than 3% across the course of the week. Well, to get across what we're seeing, particularly on the trade front and with the focus on those US stocks and the broader movement we're seeing there, particularly in the wake of reporting season, I caught up with Lachlan Hughes from Swell Asset Management.
It'll be interesting, Andrew. I'm not sure whether there'll be a resolution. Well, fingers are crossed, but it looks at the moment like the tide of US exceptionalism is running out. But I say the tide's running out because I expect it to turn it at some point. If we look at the markets today, we've got rising bond yields, but we've also got a falling US dollar. And, this situation is fairly unique, but if you look back in time, it's happened a few times before. It was these conditions prevailed under the 1970s stagflation, also post the 87 stock market crash, and then again more recently under the Bush twin deficits back in the early 2000s. So look, rising bond yields and falling currency has happened. Whether these tariffs will resolve some of that, I suspect. Look, the way the world's set up is supply chains are incredibly integrated, and the US and China reflect a supply chain. They have two-way trade of over $600 billion. So I think there is like a lot of a lot of reason for them to work together and come to a resolution. If you look at China, for example, they supply the majority of the world's rare earths, and you could live a long and happy life not worrying about rare earth supply, but it's in a lot of the products we use. For a company like GE, which we own, it's used in the diagnostic fluid that they put into you while you're doing your CT or MRI. So look, they have a lot of use, and the US needs access to those, whether it's for their chips or various other industries. So I suspect there's a lot of reason to work together, and hopefully there'll be some resolution on these tariffs, albeit maybe it's just going to see tariffs still imposed, but at a much lower rate than we're seeing today, which is 145%.
Does it concern you, though, that perhaps the damage has already been done, particularly to the US economy? We're already seeing, obviously, those shipping rates have completely collapsed between the two countries. Items are going to begin, if they haven't already, disappearing from the shelves there. What's that likely effect, even if we did have some sort of resolution more immediately?
Oh, you're spot on, Andrew. That's the great problem. All of these companies, whether it's Lowe's, Home Depot, even a business like Yeti, they'll cease to have goods on the shelves if these tariffs stay where they are today. And the problem with an economy is people can get very fearful very quickly, particularly when jobs start getting lost. And there's a lot of small business, for example, that sell Chinese products to US consumers on Amazon, and we're seeing for those small businesses, and it really is the small businesses, because a lot of the larger ones can source their inventory from other countries. It's more of a timing thing. They'll sort of sort that out over time. But for small business who rely on these cheaper goods, they're not going to be able to afford to pay the tariffs, and those businesses may be no longer after this. So look, it's a huge concern. We sort of took the view pre-Liberation Day tariffs that we would increase our cash weighting. We've kind of moved into sort of more healthcare, but increase the cash so we can respond to some of this uncertainty. And you're spot on, Andrew. I think the US economy will feel the impact of, even if there's a resolution struck today, they would still see the impact, because, as you rightly point out, shipping containers have dropped significantly. So it really is a bit of a case of watch and see. But I guess really why you want to be owning high quality businesses which have a significant amount of cash and no debt, because the stronger will get stronger, and unfortunately the weaker will get weaker.
Yeah, in fact, I don't know if you saw those comments over the weekend from Fed member Thomas Barkin saying he's hearing from retailers that the consumer is already tapped out, that they're not going to be able to pass those costs on to the consumer.
100%. I mean, the consumer is under pressure. We saw that even in a company like Block, where the Cash App, we saw a drop off in. They sort of over-indexed to the lower socioeconomic people. They're under pressure. So look, we'll see what happens. It stands to be a big problem if they can't come to some resolution, which makes me think there ultimately will be a resolution, because there has to be.
So, Lachlan, you mentioned there you want to be in high quality businesses. What's an example? What are you looking at?
Yeah, look, we've tried to position towards companies we think can grow irrespective of the macro backdrop, and we still really like AI. I know we've talked about this one previously, Andrew, but we're still very excited about the opportunities there. Cloud, around 20% of workloads are in the cloud today, so there's still 80% to transition from on-premise, so that's happening over time, sort of irrespective of the AI component. But look, AI is driving that transition as well, because if you want to access the latest AI models, you need to have your workloads in the cloud, and they continue to move across over time. And that saw very good results for an Amazon, also a great result for Microsoft. So we like those ones, Andrew. I think they've got a long way to run. It's a very long-term story there. But also, if we look at other stocks, like for our portfolio, healthcare is one where we think they've got very resilient business models, and also business models that'll do well irrespective of the macro. We like ResMed there, which is the sleep apnea business, Danaher, but also GE Healthcare, albeit that GE Healthcare has been caught in these tariff issues to some extent, because they need access to the rare earths, but also they manufacture in a number of countries. So tariffs will impact them, but from where the share price is today, we find that still a very attractive proposition.
So, Lachlan, we've pretty much at the end of reporting season. What's your takeout been?
Well, I think for me, the majority of companies have beat expectations, which I think is interesting because people may have been concerned going into this quarter, but this is up to the end of March, so we're really not seeing any impact from April. But if we look at the outlooks for nearly all companies, it's very clouded. They're concerned about tariffs. Like we said, supply chain decisions are decisions you're making for like sometimes 10 years, and if you can't get good supply of product at the right price, that affects your margins, and it also makes it very, very difficult to forecast profit going into the future. So I think companies are feeling very similar to investors now, which is, look, they're seeing the uncertainty just as we are, and at this stage they're kind of, we saw a number of companies, particularly in the airline industry, just pull guidance altogether. So yeah, look, it's hard for investors, it's hard for companies, and hopefully we see some resolution on this tariff soon.
That is the view of Lachlan Hughes from Swell Asset Management. Let's focus now on what we're likely to see this morning on the local market. SPI futures up around 0.01%. There is some buoyancy there in terms of what we saw out of those talks between China and the US over the weekend. So we're going to get right across that in just a couple of minutes' time. Stay with us.